Brindley Joinery turned over £680,000 last year. So why did the owner only keep £41,000 of profit? Welcome back to ActioFin. Last episode gave us a snapshot of the business at one date. This episode gives us the film of the whole year, the profit and loss account. By the end you will know exactly where the other £639,000 went, line by line. Our plan for this episode. First, what the profit and loss account actually measures, and how it differs from the balance sheet. Then revenue and cost of sales, the two figures that create gross profit. We look closely at gross margin, one of the most useful ratios in business. We add overheads to reach operating profit, and then follow the last steps down to net profit. We build Brindley's complete profit and loss account from real figures. And we finish with the takeaways. The profit and loss account, sometimes called the income statement, is the natural partner to the balance sheet, and the contrast is the whole point. The balance sheet freezes one exact date. The profit and loss account adds up everything that happened across a period. Usually Brindley's financial year running to the 31st of March. Every sale invoiced, every cost incurred, gets totaled from the first day of the year to the last. It answers a different question entirely, not what do we own today, but how did we actually perform this year? It is worth pausing on exactly how these two documents connect, because they are not independent. The net profit this episode calculates for the year does not simply disappear once the period closes. It flows directly into retained earnings, part of equity on the balance sheet we built last episode. This is precisely why equity grows year on year in a profitable business. Each year's profit and loss account adds its result onto the accumulated pile sitting inside equity. The two statements are, in a very real sense, two views of one continuous story. Not two unrelated documents that happen to share a company name. The profit and loss account always starts with revenue, also called turnover. The value of everything Brindley invoiced customers for during the year. One point trips up almost every new business owner: revenue excludes VAT. When Brindley invoices a customer £1,200 including VAT, only £1,000 is revenue. The remaining £200 is collected on behalf of HMRC and never belongs to the business at all. Get this wrong and your whole profit and loss account is quietly inflated from the very first line. A subtlety worth flagging now, because we will return to it properly in episode 9. Revenue is recorded when the work is delivered and invoiced, not when the customer actually pays. If Brindley fits a kitchen in March and invoices it the same month, that revenue belongs in March's profit and loss account even if the customer does not pay until May. This is the accruals basis of accounting at work. And it means a healthier-looking revenue line does not automatically mean the cash has landed yet. A distinction that becomes very important once we reach the cash side of the business later in this series. Directly beneath revenue sits cost of sales, sometimes called cost of goods sold. This is the direct cost of producing what you actually sold, nothing more general than that. For Brindley, cost of sales means the timber and hardware that went into the kitchens and staircases delivered this year, plus the wages of the fitters working directly on those jobs. It does not include the office rent or the owner's own salary, those come later as overheads. Getting this line right, and only this line, is what makes the next figure meaningful. Subtract cost of sales from revenue and you get gross profit, the first genuinely useful signal in the whole account. Express it as a percentage of revenue and you get gross margin. One of the most watched ratios in any business, because it tells you, before any overhead is even considered, How much of every pound of sales survives its direct costs? A joinery workshop typically expects a gross margin somewhere between 35 and 45%. Anything meaningfully below that, and either pricing or material waste needs urgent attention. Gross margin only means something when you know what is normal for the trade. Because a healthy margin in one sector would be alarming in another. Bespoke joinery like Brindley's typically sits between 35 and 45%, reflecting skilled labor and custom material use. General building work often runs lower, 20 to 30%, because subcontracting and material costs dominate. Professional services can sit far higher, with little direct material cost at all. Retail sits somewhere in between. Comparing Brindley's margin against joinery peers, not against a professional services firm, is what makes the comparison actually useful. Below gross profit come overheads, sometimes called operating expenses. These are the costs of simply keeping the business open, whether it fits one kitchen this month or 10. For Brindley, that means the workshop rent, insurance, the office manager's wages, marketing spend, and the accountant's fees. Unlike cost of sales, overheads do not move directly with each job. This is exactly the fixed cost idea that matters right across finance. Overheads must be covered by gross profit before a single pound of real profit exists. Subtract overheads from gross profit and you land on operating profit, sometimes called profit from operations. This is arguably the single most honest figure in the whole account. Because it measures what the core trading business earns, before interest on any loan, before corporation tax, and before any one-off item that has nothing to do with day-to-day trading. A bank assessing whether to lend to Brindley will look at operating profit first. Precisely because it strips out financing decisions and focuses purely on whether the joinery business itself works. From operating profit, deduct interest on the bank loan financing the workshop unit, and then deduct corporation tax. Currently charged at 19% for smaller companies with profits under £50,000 and up to 25% above £250,000. With marginal relief tapering in between. What remains is net profit, sometimes called profit after tax. This is the number that truly belongs to the owner. Whether it is paid out as dividends or reinvested back into the workshop. Let us build the whole thing for Brindley Joinery's year. Revenue comes to £680,000. Cost of sales, timber, hardware and the fitter's direct wages, totals £394,000. That leaves gross profit of £286,000, a healthy 42% margin for the trade. Overheads, rent, office wages, insurance and everything else that runs regardless of workload, come to £221,000. Subtract that and operating profit lands at £65,000. It is worth opening up that overheads figure because a single number invites no action, while its breakdown often does. Office and administration wages, including the owner's own salary, take the largest share at £68,000. Workshop rent and business rates come to £54,000. Insurance is £19,000. Running the delivery van costs £24,000 a year in fuel, servicing and tax. And marketing, professional fees and everything else not captured elsewhere adds up to £56,000. Seeing overhead split this way is exactly what lets an owner ask which line, if any, genuinely needs trimming. The final steps are quick but they matter. Interest on the workshop bank loan costs £6,000 a year. Corporation tax on the remaining profit, at the small company's rate of 19%, takes a further £18,000. That brings net profit to £41,000, the true final figure the owner actually keeps from a year of turning over £680,000. It is a perfectly respectable result for a 6-person workshop. But seeing it laid out this way is exactly why the owner had never quite trusted the headline turnover figure alone. This chart shows the whole story in one glance. Revenue of £680,000 shrinks to gross profit of £286,000 once direct costs are removed. It shrinks further to £65,000 once overheads are covered. And it shrinks one last time to £41,000 once interest and tax are paid. Each step removes a genuinely necessary cost. But watching the bars fall like this is precisely why an owner who only ever looks at turnover is looking at the least useful number on the entire page. Expressed as a percentage. Brindley's net profit of £41,000 against revenue of £680,000 gives a net margin of roughly 6%. On its own that number means little, but set against comparable joinery workshops, which typically land somewhere between 5 and 9% net margin, it places Brindley squarely in respectable, middle-of-the-pack territory. That is a useful anchor for the owner, not a business in trouble, but not yet an exceptional performer either. And exactly the kind of business where the sharper analysis in later episodes of this series. Splitting product lines and customers apart tends to reveal real room for improvement. One more line worth keeping visibly separate on the profit and loss account: other income. If Brindley receives a small government grant toward apprenticeship training, or an insurance payout after a minor workshop incident, or simply earns a little interest on a business savings account, none of that is ordinary trading revenue from selling joinery. Good practice keeps these items on their own clearly labeled line rather than blending them into sales. Precisely because a reader trying to judge core trading performance, a bank especially, needs to strip out one-off or non-trading income before judging whether the underlying business is genuinely strong. And mixing it into ordinary sales would flatter a single year without reflecting anything repeatable. For an owner-director business like Brindley, one detail regularly confuses people reading the accounts for the first time. A salary paid to the director sits inside overheads on the profit and loss account as a genuine business expense reducing profit, exactly like any other employee's wages. Dividends, by contrast, paid out of profit after corporation tax has already been calculated, never appear as an expense on the profit and loss account at all. They are a distribution of profit already earned, not a cost of earning it. Many small company owners deliberately blend a modest salary with dividends for tax efficiency. And understanding this split explains why the P&L and the personal tax return can look quite different, even for the exact same owner-director in the exact same year. Everything in this episode has focused on the full financial year, because that is what statutory accounts require. But the same profit and loss structure works perfectly well produced monthly, using exactly the same nominal ledger, well before the year even closes. Brindley's bookkeeper now runs a rough monthly profit and loss account, comparing it against the same month last year and against a simple internal target. If gross margin on kitchen starts slipping in March, the owner finds out within weeks, not 11 months later when the accountant finally delivers the year-end figures, by which point the pattern has already cost real money. It is worth remembering that the annual profit and loss account smooths over a genuinely uneven year. Brindley, like many trades tied to home renovation, sees noticeably higher revenue through spring and early summer, when homeowners commission kitchen and staircase work ahead of selling a house or hosting family, and a quieter patch through the depths of winter. Looking only at the annual total hides this seasonality completely. A monthly or quarterly breakdown reveals it clearly, and lets the owner plan cash and staffing around the pattern instead of being surprised by it every single year as though it were new information. It is worth knowing which document a lender actually reaches for first, because it is not always the one an owner expects. When Brindley applied for additional finance to extend the workshop, the bank's first request was 3 years of profit and loss accounts, not the balance sheet. A lender wants to see a consistent, ideally growing, trend of operating profit before it even considers what assets currently sit on the books. Because trading performance is the strongest evidence that a loan will actually be repaid from ongoing income rather than from selling off assets under pressure. Knowing this in advance let Brindley's owner prepare a confident, well-organized 3-year summary rather than scrambling once the request landed. And the meeting went ahead entirely on his terms rather than the bank's, ending in an approved facility within a fortnight. 3 mistakes to watch for. First, chasing turnover as the headline success measure, when a bigger top line means little if gross margin is quietly eroding beneath it. Second, misclassifying costs, pushing overheads into cost of sales, which inflates gross margin and hides the real trading picture from everyone reading the accounts. Third, ignoring one-off items, a single large insurance payout or a government grant can flatten net profit for exactly 1 year. And a careful reader always checks the notes before judging a trend. To bring it together, the profit and loss account measures a whole trading period, following revenue down through every cost to the final result. And that final result flows straight into equity on the balance sheet. Revenue always excludes VAT, which never belonged to the business. Gross margin is the first genuine health signal, well before overheads even enter the picture. And net profit, after interest and corporation tax, is the only figure that truly survives to the owner. Everything in between is a necessary cost worth understanding, not just subtracting. You now understand what the balance sheet and the profit and loss account actually show. Next episode we open the engine room and see how every single figure gets there in the first place. Double entry bookkeeping, debits, credits, and the trial balance. The full course, with calculators and practice cases, is on ActioFin.com. See you in episode 4.